This is Nate Dodson, and you're tuning into And This Is Why, the podcast show. A show where we help you take your business to the next level. New episodes every week streaming on your favorite streaming platforms. Enjoy today's episodes. Hey guys, today I want to introduce you to a truly amazing investment sponsor. He's really focused on a unique niche that is truly the next big thing to be in. You know, for the last, I'd say 14 years, multifamily has been amazing. At this point, it's kind of run its course. So everybody's kind of scrambling, thinking, what's next? What should I jump into? And I got to tell you, the guy that we're introducing today, David Peters, he's there, but not only is he just getting there now, he's got the experience, the name, he's been doing it. So we're going to learn a little bit about him as well as his investments process and how all that works. So at the end of the day, we can talk all about doing hotel syndications, buying, it's business, it's real estate, it's all of the above with David Peters, and this is why. David, thank you so much for being here today. Really appreciate it.
Well, thanks for giving me the opportunity to get to introduce myself to your group. So I'm appreciative of that.
Well, definitely. I know you've been around the block for a long time. We've worked with you for quite a long time now, but you've been in such a unique niche. And I know when we first started working together, you're really focused on hotels and in hotel investing at a time that really nobody else was looking at it. And now it's getting to be a bigger and bigger market. More and more people are interested. I would love to hear kind of your backstory of how you actually got into hotel investing and operations.
Sure. Yeah. it was kind of a winding path, actually. From an education standpoint, I got my degree in electrical engineering. I started working for corporate America. I actually worked one corporate job with a company called Honeywell that then became Alliant Tech Systems. And at that job, I was actually designing guidance and control systems for military weapons. So, obviously a long ways away from real estate, right?
I don't know, it goes hand in hand, blowing stuff up and demolishing, old buildings. It could go.
Basically, yeah, I worked there for about a decade and it just wasn't where my heart was. So I decided I wanted to branch out on my own. And the first thing I did is I started an IT business back in the 1990s. So, I spent about 7 years running that business, building it up, eventually selling it off. What we did there was, we were kind of at that time where the internet really didn't exist when we started. It was very, very limited. And we took businesses from, basically green screens on their desk to having PCs and shared printers and email and all that kind of stuff, right? And that was that was the right time. But then we got to Y2K and like every business upgraded all their systems that same year. So I was like, well, this is the best year I'm ever going to have. It's maybe time to start thinking about something else, right? So I left there. I did a whole bunch of other funky things, from trying to help a .com company go public. And I ran a power sports business, tried to help them set up their supply chain in China, and eventually I got to the point where it was like, I want to do something different. And a friend of mine approached me and he said, hey, what about starting a general contracting business? This was about, I think, 2003. And I said, well, that sounds interesting to me, but I know nothing about building things. I know how to build businesses, but I don't know how to build things. And he was really talented at knowing how to build things. I can remember the first time we went to the hardware store. He's like, well, we got to get these 2x4s. We got to get this and that. I'm like, what's a 2x4? That's how little I knew at that time. So, over a progression of about 5 years, we built a business where we were essentially being the picks and shovels for all these flippers back in the 2003 to 2007 time frame, right? So I got my general contracting license, learned how to do everything from foundations to roofs, residential and commercial. And then 2008 comes, right? And the market crashes and I'm like, okay, we didn't have any customers anymore. So I said, I guess I got to become my own customer, right? So I had some money saved up and started doing, your smaller flips, single family, small multifamily flips. Found that wasn't very tax efficient. So then moved into the rental portfolio, built up a portfolio here in Minneapolis where I've been living for my entire life almost. And at some point, probably about 2015, 2016, I said, yeah, I don't know if this is the permanent answer either. So I got connected to some of these education groups back then to learn about multifamily syndication. Got involved in some projects back then. And then, early 2019, I'm kind of looking around, and I mean, little did I know that prices were going to double from 2019 to 2021, but it looked really expensive to me then. So I said, I got to find something else. I got to find something that makes financial sense to me, being an electrical engineer, I'm a real mathy kind of guy. So a friend of mine brought this deal to me in the Twin Cities here, and he said, look at these numbers, and I said, well, he said, this is a multifamily deal. And I said, who's going to sell a multifamily at an 8 cap in Minneapolis? Nobody, right? So he said, no, wait a minute. It's not quite a multifamily. It's going to be a multifamily. It was a hotel. It was a hotel that he was going to convert. So when he introduced me to that model, it just made so much sense to me that I'm like, this is it. So I started digging in, and so I got involved. That's when I got involved back in 2019, before COVID, right? Early 2019, late 2018, got involved in looking at that model. And then we started doing projects together. He and I did a project together. And then from there, it just kind of carried on. I started doing some other projects with some other people. So, fast forward to today, now, we've got, looks like we're going under contract for our 6th and 7th projects on these conversions now, probably within the next week or two.
Congratulations. So are all of the hotel acquisitions converting into multifamily, or are some of them you're running as hospitality ventures?
Actually, it's interesting that you would be perceptive enough to ask that question, because we actually have a spectrum that we operate on, right? I mean, on one end of the spectrum, you're going to have a traditional nightly hotel, which is never what we really want to do. I don't believe that that's a good model, and I especially don't love the purely traditional multifamily hotels, with franchises. I mean, I think that's just not the best way to go. So some of these properties we actually run as what I'll call hybrid models, where we do both extended stay, monthly guests, and we do, we pick up some of that like Airbnb nightly business as well. And some of them we take all the way to the other end of the spectrum, which would be full multifamily. So yeah, there's kind of a spectrum there that we're doing. We've done, a couple of each.
I love that you were doing the hotels to multifamily. And if anybody's wondering, why would you do that? David actually answered that question without going to that next step. If you can buy a hotel at an 8 cap, and multifamily was, I'm sure at that point, selling at a 3.5, 4 cap, you're almost getting double the value by making the switch from a hotel hospitality to a multifamily, just getting the gain from that one kind of repositioning of the property. Brilliant. I'm sure it actually took quite a bit of demo construction. Of course, you had already a lot of the experience in that area. Could you kind of talk through so people understand, if you're going from hotel to multifamily, what kind of changes are you generally making? We've all been to a Radisson. We know what's not there. But what are you at?
Yeah, sure. First of all, I'll just say really quickly that typically the numbers are, like you said, a double or a half as far as the cap rates go. But what we're actually looking at is 12s to 6s. So, we're making a ton of money selling at a 6 cap, which is, obviously nice to be able to do that in today's current economy, right? Because 3 and 4 caps, they're not viable now. I don't know if they'll ever be viable again. I think it'd be best for our society probably if they weren't. But, I think one of the things that people have to realize in doing this is that when you get a hotel, you actually have what they call a hotel certificate of occupancy, right? That's kind of the legal thing that allows you to operate your hotel along with your hotel license. But a lot of people don't realize that if you're actually going all the way over to residential, you're going to turn this into a true apartment building, you have to convert to a residential certificate of occupancy. So you have to, it's not, people always talk about, I got to get the thing zoned for being a multifamily, right? Or it's already zoned to be a multifamily. And that isn't, the nirvana. The nirvana is, here's what I need to do to get a residential certificate of occupancy, because even if it's zoned, if you don't have any occupancy certificates, you really have nothing. So, that's kind of the real difference. And there are certain things that come up quite frequently, things related to, obviously, a lot of these properties we buy, some people will buy extended stay, and we're actually looking at buying an extended stay hotel now. So they do have existing kitchens, but most of them that we buy do not have existing kitchens, right? So we obviously have to figure out how are we going to get that in? And some of the things that come up in that process are, how are you going to get drains for the kitchen sink? And, does the actual building have the capacity to, handle the additional electrical load? Because if you're going to have to bring in additional electrical, that could be very, very expensive. It's not so expensive to necessarily maybe wire in from the existing junction boxes or circuit breaker boxes, but bringing in additional capacity to the building itself could be hundreds of thousands of dollars. And then there's some other gotchas too. Like, we deal with a lot of properties that are, vintage 1980 to 2000, and many of those did not have full sprinkler systems in them as hotels. And that was okay back then from an occupancy standpoint. But now, a lot of times, most municipalities aren't going to allow you to grandfather that in. They're going to say, hey, you need to put that in if it's not already in your rooms. So that there can be hundreds of thousands of dollars. There's other like little things that you'd never even think of, like maybe your elevator size is too small. They have this gurney requirement for residential. And if your elevator can't properly fit an ambulance gurney in it, and they have specific measurements for that, they'll come and say, well, yeah, you got to maybe widen your elevator a foot. And it's like, widen it a foot, that's going to cost me $350,000, $400,000, $700,000, right? So when you're buying properties, you definitely better, do your due diligence so you know what you got when you're going into the thing.
It completely sounds like you have to have that background and that experience and going through it. Definitely not something like, hey, I've done multifamily, I know I can just jump out there and do this hotel conversion. It's actually more of a development and a construction process. Getting the entitlements, getting the approvals, getting the COs, which, oh my God, that can be such a pain.
And then if you end up hitting a certain ratio of renovation versus purchase price, which is very common to hit because you're typically buying these things very, very cheap and putting a bunch of money into them, then all of a sudden the city wants to treat that as a new development plan. So you better make sure you have enough soft cost in your budget, because you're going to be doing full engineering on it. You're going to be doing full architectural on it. I'm like, well, we're just going to put a new roof on, put some new windows on, do some work in the, repave the parking lot, stuff like that, right? And all of a sudden the city's like, oh, no, hold on. We need to have you do a drainage study, and maybe you need to move your drain baskets, and maybe you need to change where your egress and entrances to the, with the road, and maybe you need to add 5 parking spots. And, oh, by the way, if you're going to do that, then you've got to meet all these ADA compliances on your sidewalks. It's just like, it's like just, I think the average multifamily person they say, well, I've done a multifamily value add. It's like, well, yeah, but you've never had to go from hotel certificates of occupancy to residential certificates of occupancy. And that's where the city has that hook.
I love it. If I was a multifamily syndicator, I've been doing it forever. And you know what? I'm just not seeing the product anymore. I'm really thinking about pivoting. And you know what? These hotel syndications and conversions, it just makes a ton of sense to me. What would you tell me in order to, should I do it? Should I not do it? Should I partner with somebody like yourself? Like, what's the right approach? Because it is definitely a smaller niche compared to just buying apartments.
Well, for sure, it's a smaller niche, although, there are quite a few hotels out there that can be converted. We're talking, probably upwards of 100,000 hotels that could possibly be converted. So there's plenty of work to do there if you're looking for it. I would say, I think if it's your first one or first couple, either partner with somebody like me who's, obviously leading these projects, or find a contractor who's done them before.
Do you know any kind of education groups? I know you're a big educator. I don't know if you actually have a group that you work with, but, if I wanted to learn more, what would you tell me to do?
I would tell you to attend one of our upcoming 3-day weekend seminars. Yeah, I think we've just actually formed an organization called H2A, Hotels to Apartments, and we have a 3-day educational weekend that basically, gets you kind of an introduction to it. And then behind that, we actually have what we call cohorts that we're forming that people can join. And basically, I mean, it isn't like a traditional mentoring program. It's actually a true partnership program where what we're looking to do is bring in people that we can train that can then go out and find deals and work with us directly. And we're looking at, obviously it depends upon the size of the deal and the group of the people involved. We're looking at more of a true business ownership model as opposed to, maybe the more traditional syndication model. So we're looking at, bringing groups of people together. We may, form that as a syndication, but we're not looking to do it, with your traditional, we're going to have a 7% profit, we're going to have a 2% acquisition fee and a 1% can't think of the word now.
Disposition, acquisition, asset management, blah, blah.
Right, exactly. We're looking to eliminate all those fees and have, basically everybody participating actively in the investment to make it a true business, right? And I mean, active participation in one of these projects, once we've got the property stabilized, it's not like you're going to, you need 40 hours a week to participate, right? I mean, a few hours a month for us to meet together and strategize is all you're really going to need as an active investor to be involved. But it's going to be true ownership, right? You're going to have shares to vote. I mean, typically, we're not doing these deals with 75, 100 investors. We're looking to do these deals with, some of my deals we've had 3. Okay. So, and I think that's just so much more impactful too, right? I mean, you put $10,000 into a syndication, right? I mean, it's like, oh, wow, I got my, check for $2,000. And lately, of course, it's maybe a check for 200 or nothing, right? With these apartment syndications, I mean, honestly, that just doesn't feel impactful to me. In these types of deals where you own 20% of the property, 30% of the property, I have investments now where, we generate $100,000 to me personally in distributions, over $100,000 on one property. Amazing. How impactful is that versus, $1,500 or $200 a year?
You know what?
It's $40 into this either, so.
So you mentioned the H2A. Is there a website or someplace that anybody listening can actually go check it out and see what you're doing and sign up to participate?
Yeah. Hotel2apartments.com with the number 2. Hotel2apartments.com.
Yeah. Perfect. Absolutely love it. And so is there a difference between you had mentioned the apartments, which, the hotel rooms are pretty small. Do you actually end up combining a few hotel rooms to make more of a sizable living space, or is it more like how you're picking the property?
No, that's actually a really great question. And I think when people first, obviously COVID drove a lot of people to look at this model, right? Because they saw that there were like hundreds, if not thousands of hotels that were financially in trouble, traditional nightly hotels that were never going to open again under the same management because a lot of these things were smaller. They were owned by families or groups of individuals. And they just, obviously nobody has, or most people don't have the reserves to ever plan for a COVID event, right? Like, okay, your business is going to go from, $100,000 a month revenue to $5,000 a month for 9 months, right? Nobody prepares for that. So, a lot of people looked at it and they said, hey, yeah, we'll come in and we'll create this true apartment building, right? We'll go and we'll take these rooms and we'll combine 3 together to make a 2-bedroom unit, and we'll combine 2 together to make a 1-bedroom unit. And, but the reality is, from a financial standpoint, if you can fill up all your units as individual units, you're just going to do a lot better financially because, let's say we're doing a studio unit at 800. We combine 2 together to make a 1-bedroom. Are we going to get 1,600? No, probably 1,100, right? So, if you look at the numbers, from just electrical engineer, mathematical standpoint, right? But I realize that we're not operating in a vacuum, right? And people say, well, what about, studios, right?
It's interesting. So you don't double the sizes, you don't combine them unless you absolutely have to, but you're more creating studios, or where there's suites. Of course, it does look like a more normal.
Right, and we do actually. Fortunately, most hotels do have some suites, but obviously the preponderance is going to be your standard rooms, right?
Yep.
So the studio apartment, right? You can see this on your screen, right? My question:
Who would ever live in a studio apartment?
Exactly, perfect. So here's the magic chart. Now, what if you could find like a trend that's been going for 60 to 70 years? Would you think that's like a mega trend, like a trend that's never broke in 60 or 70 years?
Definitely. And I've also seen the 200 square foot apartments in New York City and San Diego. So we all know living situations are getting smaller and smaller, and also more expensive. So I definitely get it.
Here's the chart. Here's the goal. There it is right there. You see that red line?
Yep.
That's households that actually have children, okay? That blue line is single person households, not like couples, but actually one person households. So if you look at that chart, it might be hard to read, but you're looking at a chart from 1960 to 2020, okay?
And it looks like the singles households went from about 10 million all the way up to almost 40 million, almost a quadruple
From
increase.
8 million, to almost 40 million.
Massive change.
500%. Whereas households with children grew by 33%.
I think one of the most interesting things, you have 33%, but that's maybe 25 million up to now around 35 million. But the thing that really strikes me about the chart that we're looking at is a little after 2000, the number of households with children is actually decreasing.
Correct.
So it is not only the huge increase of the number of single persons households, it's the fact that there just should be less demand for the larger McMansions or the single family homes, because who really needs all that space?
Correct. That's exactly it. These single person households have just exploded. And if you look at that trend line, I mean, yeah, there was a little blip there around like when the housing crash hit, right? Between, I guess probably 2007 and 2009 or 2010, right? But other than that, this line has been unbroken, right? The trend has been unbroken for 60 years. And we're just seeing it more and more, right? I mean, now there are actually more single-person households than there are households with children. And, I mean, if you think that trend line is going to break anytime soon, think about all the new residents of our country that are coming in every day. Most of those are single-person households.
You know what? This is a kind of a sad statistic to throw out there, but the divorce rates and how those have grown from 1960 to now, and even more so, it's more than 50% of married couples end up being divorced. Hey, that also creates more and more single-person households just from that weird statistic. So unfortunately, I absolutely see that trend continuing long term.
Yeah, and people are living longer, and when people live longer, you have widowed spouses. When people start their lives, if they do get married, they stay single a lot longer. So we kind of have our market runs across the whole spectrum, but it's definitely somewhat of a barbell market. We definitely have a lot of people in the younger cohort and a lot of people in the older cohort, and maybe less so in that sort of middle cohort, that maybe, let's say, 35 to 55 age group. But overall, our customer base is growing and growing and growing. And I do have one more chart, I guess, and I think we already talked about this. I'll jump back to that chart. And it's sort of the other side of why this is so compelling. Rental affordability now is at an all-time low. Now, obviously, maybe that'll improve if the market crashes or the economy crashes and the Federal Reserve has to lower interest rates. That might improve a little bit. But there again, I mean, you're looking at a 20-year trend line, right? And it's had little fits and starts, but the sawtooth just keeps going lower, lower and lower and lower.
And so we're seeing the affordability from 2001 to current fall by about 50%. Like that's a massive drop.
Yeah, actually, it's probably more like 40, but yeah, it's huge. It's an absolutely huge. And people don't want to, would you want to live in an 800 square foot apartment in a C-minus neighborhood with no amenities versus living in, say, an A-minus neighborhood with a 300 square foot apartment, but the building itself has, a really nice outdoor courtyard, maybe pickleball courts, a fitness center, a community room, a theater room. I mean, we're just seeing that people are saying, hey, I'd rather, take the 300 square foot that's small but lives large because of the amenities versus the larger unit that's in maybe an area I don't want to live.
For better or worse, something else that I would think about, and maybe you can comment it along the same lines, is so much our culture has grown in this, hey, get your house with the white picket fence and the single family home out there in the suburbs. But honestly, it's created this divide within the community because everybody's not together. And I see this where it is very communal, creating that culture of connectiveness with neighbors so much more than back in the suburbs.
Yeah, we see that as a strong way to retain our residents as well, for sure, building that sense of community. Yeah. So I think people do want that, and especially the cohorts that are most common in our properties, right? The young single people and the older single people, right?
With your properties, do you have kind of an active community manager that is putting on events and trying to create that connection as well? Or is it just naturally happening?
Both. I mean, we definitely are aware of it. We definitely do some things that, will draw people together. And we definitely want to provide the spaces that allow for people to kind of get together, like, patios with pergolas and barbecue grills, right? I mean, that's a great way to, people come home from work at night and they want to throw something on the barbecue and they come out and they meet their neighbor, right?
Absolutely love it. So you also brought up, and I've been meaning to ask you about the long-term stay Airbnb style hotel conversions versus the apartments. And I'd love for you to kind of explain. I don't understand what would be the difference there. Is it just zoning, or really is the presentation and the build out different?
Well, one of the big differences, obviously, on the build out itself is going to be the cost of the build out potentially, because with hotel certificates of occupancy and hotel licenses in almost every jurisdiction I've looked at, they basically don't have a separation of hotels. Like, you don't have to meet a certain standard as an extended stay hotel versus a nightly hotel. It's just, you're a hotel and you're allowed to do, extended stay hotel operations under that. So basically, if you're buying a building that, let's say, is an older building, and, the cost to maybe put in the sprinkler system or to update the electrical, or to maybe that whole elevator thing comes into play, it makes more sense to continue to operate under that hotel license. But the real reason a lot of times we make this decision is, for instance, I mean, in a property that you have some familiarity with, one that I own in Thomasville, the reason that we chose that operating model was because Thomasville was actually a strong market for both hotels and for multifamily, as far as very low vacancy in both of those segments. So what we do is we say, okay, why not, grab both of those demographics? Because ultimately what we want to do is, our success is going to be determined by occupancy, right? And maybe a lot of people who haven't looked at hotels don't realize that it's not uncommon for hotels to operate at 30 or 40% occupancy. So you've got, you have like surge occupancy, right? You might have, the Taylor Swift concert, we were 100% occupied. Well, that was 2 nights out of the year, right? So, I mean, how many of those events do you have? I mean, if you're, a hotel that's, in downtown Minneapolis by the convention center, maybe that makes sense to be a nightly only hotel because you just have event after event after event. But if you're, a hotel in Thomasville, Georgia, where, the population is under 50,000 people, do you want to say, well, yeah, I'm going to operate as a traditional hotel and I'm just going to live with 30% occupancy 80% of the year? And I just say, no, we're going to sacrifice a little bit of the upside by saying, okay, we're going to target, to operate this property as about 50% long-term people and 50%, Airbnb and short-term, traditional hotel type people. That way, we can keep our occupancy, 80, 90% all the time rather than, wasting that resource, and then we can capture those higher rates that people pay when they stay for, 2-3 nights or a week or, maybe a couple weeks, as opposed to, we have people who, honestly stay there, without a termination date. They're essentially proxy apartments, right? I mean, we have, our Sioux Falls property, we have probably 70% proxy apartments and 30%, of the, what I call transient stay people, because that way it stabilizes our revenue year round, because Sioux Falls is, it gets cold in the winter. I mean, there isn't a huge demand for nightly stays in Sioux Falls in January and February, unless you're again talking about, a weekend dart tournament or, a kids sporting event tournament or something like that. So we want to look at the market and examine, okay, how can we, maximize revenue by, I call it like turning a dial, right? On the far left end of the dial, you have, your traditional nightly hotel, and on the far right end of the dial, you have, the 100% multifamily model. And I think even like Overland Park now is going to be all multifamily, but I think we will probably keep a certain percentage of those units as furnished, just because, it may be only 10% of those units, but there's certainly the opportunity to capture that Airbnb business on 10% of the units, or that nightly business where, once in a while you're going to have a night where you can get $200 a night for those rooms, So it's kind of we try to grab the best of both sides.
So let me ask you this, because you brought up something that I find very interesting. You're saying that an average hotel there may have 30 to 40% occupancy on an ongoing basis. Multifamily, stabilizes 95%. It's
right,
night and day different. How does this come into your pro forma analysis in deciding what properties to buy and how to reposition?
Well, obviously it's not all that different from multifamily when you're talking about, what properties to buy. I think you want to buy in decent neighborhoods. I generally, I'm not doing C- neighborhoods with these hotels. Unfortunately, most of them aren't built in C- neighborhoods. Now, granted, some areas they decline from a B to a D, right, over time, and so the hotel's just stuck there. But like for instance, we have one now that we're literally putting ink to a contract on in Louisville, and that property is a true unicorn. It's literally a D property in an A neighborhood.
There's that upside.
Right. And it's an extended stay already. So, our lift on it isn't as heavy, and it's got, it has an elevator that's compliant, and it's got sprinklers in the rooms already because it wasn't built too long ago. So, there's so many properties that would work with this model that we actually honestly kind of get to cherry pick at this point. At some point in the market cycle, I'm sure that a bunch of these things will get converted, and then there'll be, we may have to kind of look down the scale a little bit, right? But we look for, growing communities, we look for, B-type neighborhoods, maybe A-type neighborhoods, when the opportunity comes up, and these hotels, one of the things we really have to do is push back against the sellers, because some of these sellers, they'll say, oh, it's a prime candidate for a hotel conversion. And all that means is they want to steal some of your pro forma, they want to grab some of your conversion profit, and they want to charge you too much, but there's formulas for how hotels are typically sold. And a lot of the, we look at a lot of what we call economy hotels, or mid-scale, low mid-scale hotels. And generally those are sold on multiples of revenue. So you might be somewhere between 3 and 4.5 times revenue. So if you got some guy, like we're looking at a property now in a market where it's a smaller market, and this guy's got this property, he's hung up on this $3 million price, but yet the property, I mean, he doesn't even have good financials, and what he does shows that he's got revenue of $600,000 a year. And he's like, well, but it's a conversion opportunity. And I said, are you going to convert it? Well, no, you are. And I said, well, okay, it's my conversion opportunity. If I decide to convert it, I want to buy it from you as a hotel. And as a hotel, it's only worth, $2.4 million. So, unless you're going to, do some magic, that's the price.
So in that example, it seems like there's an opportunity there for him to actually kick in a property as equity to make it all happen. Have you ever seen that come together? Because he's already telling you this is what should be done. And the answer is rightfully, well, I'm buying a hotel and I'm going to do that. But are you putting in money to make it happen too? Do you ever see those deals come together?
We do. Yeah, we actually, in fact, I think right now, the market in general, I mean, even in the multifamily market, I think 3 out of 4 deals I see that actually go through in the multifamily market now involve, some type of seller financing, or they involve the loan assumption, or maybe both, right? Because right now, the reality is, even for me, experience, having done several projects, having a good track record. I mean, when I go out to the market to get debt right now on these types of projects, I can't go to Fannie and Freddie and say, hey, I want, apartment debt, right? I have to go to a bridge lender, or maybe a local or regional bank, right? And the bank's going to give me, better debt than the bridge lender, but the bank's also going to want full recourse. And even in that case, I mean, I can't get anything below prime, and prime is 8.5, right? I'm lucky if I can get below 10, right? So that has to be factored into the pricing of these deals, right? And the sellers have to know that. So yeah, we've had, on the Overland property, our seller actually took all of his proceeds coming out and rolled it back into the deal. So
absolutely love it.
And we were looking at another deal in Kansas City area where the seller is going to do 100% seller financing, a 10-year note at 5%.
That's phenomenal.
But
no brainer and unavailable in the markets today if you got to go borrow it from a traditional lender.
Exactly. But they just know that, otherwise their only other option is to discount the property more, right? So if they want to get a certain price target, and I think that may be the situation with that Georgia property is, we come down to it and we say, look, if you're really hung up on this number, then you give us, a 10-year note at 3% interest, right? And so then we get our money back over time through the interest savings or something like that.
I absolutely love it. With the time that we have now, I know we've helped you put together a number of investments. Some of them, not all of them, you can actually advertise, generally solicit, tell the world about it.
Right.
Do you have any of those that are out there and you're trying to capitalize and you love to just kind of talk about right now?
Sure. Yeah. Actually, we really only have one that I would say is like immediately or soon to be available, right? Like within the next couple of weeks, I think. We have a hotel, like actually the one I alluded to before. I mentioned that, you're familiar with the Thomasville Hotel. We're actually doing the second half of our offering on that property right now. That's Thomasville, Georgia. I mean, I guess I can just throw up a couple slides again on that, maybe.
Great.
Just to kind of give people like a picture of it, right? We're not going to like grind through all the details. If people, say, hey, this looks interesting to me, I'll tell them how they can get a hold of me, right?
And let me just kind of throw this out for the world. This is called testing the waters. He's talking about something that's not ready, still getting worked on. Everything's getting figured out, not accepting any money. This is the definition of testing the waters, but it also is completely legal to talk about these. Hey, we're thinking about and working on these deals.
Oh, here's something cool. Just let this play through really quick here. That's just a sample of what they're doing now in these micro apartments.
Wow. So what we're seeing is like, it looks like a studio, but the bed will come down onto the couch. or the bookshelves will move out, and then you have the closet
You're like
behind. That is amazing.
Storage. It is. Now these types of things, they're coming down in price fast as they work on the designs, but they're still talking, a lot of these kind of setups are like $40,000. So it's not going to make sense in a small market, right? But you pick up something, say, oceanfront in Florida. Like I saw the other day, somebody had a vacant hotel, a 1980 vacant hotel on the water in Florida, right? This would be prime for that.
I'm ready to long-term stay there. That sounds great.
Yeah, no, I think it's totally livable. Again, now, not livable for, mom and dad and their 3 kids probably, right? But an individual or a couple, right? And as we saw with that chart before, like lots of those people are around.
More and more. I love it.
So let's jump ahead here. Here's just Thomasville, okay?
Okay.
So this is just a picture of it. Now, basically what this is this is a property. This used to be the worst property in the entire city. It was called like the Serena Inn or something. I don't know if that's like a minor franchise or something like that, but basically it closed like 3 years ago because they had gotten to the point where they had gone through the death spiral of hotels. And basically the death spiral is basically you don't maintain your hotel, so the only thing you could do is reduce the price of the rooms. You reduce the price of the rooms, you get worse people. The people trash the place worse. You have no money to fix it up, so you reduce the price again. Okay?
Makes sense.
Yeah. So basically this went through a death spiral. It got purchased by another investor. They did a gut to the studs renovation on this property to make it like essentially brand new. Okay? And then they found another property that they really wanted to do, so they wanted to get out of this one quickly. So they gave us an amazing price on this property. And this is one that, like I think I mentioned earlier, we're doing that hybrid model on that, essentially like 50-50 model. And you can't see it perfectly in the picture here, but there's actually 2 buildings. So we're able to kind of segregate the people. The people who stay longer stay in one area of the building. The people who are shorter stay in another area. So I think that kind of helps with the occupancy.
So if I'm staying there for the night, I'm not looking at the bicycles and everything that is just right outside the door from the long-term stay individuals.
You got it. Exactly.
Makes perfect sense.
There you go.
Oh, I've seen this language before. It is quite literally the testing the waters disclaimer. So that's why you are the smart guy to stay out of trouble. You're just doing everything right.
Exactly. And thank you for the language. I could have never written it myself.
Anytime.
So here's just like a really quick rundown of like the hotel itself. It was built in 87. It's got 96 rooms. As again, I said, completely renovated over the 2021-22 time frame, completely ready for, again, hotel certificates of occupancy and completely prepped. We're partnering actually with Red Roof Inn. We actually do have a Red Roof Inn franchise attached to this property. Generally speaking, I'm not a lover of franchises, but Red Roof Inn is a really good name. It's well recognized in this community. And it's probably one of the more flexible franchises. We're one of very few Red Roof Inns that they've allowed to operate with sort of this, long-term, short-term model. Generally, when people want to do the long-term, short-term model, they require a dual franchise because Red Roof actually does now have a franchise. I think it's Hometown Suites. I think, I don't know, there's a whole bunch of these new extended stay franchises that sound the same, Town Place Suites, Town Square, but I think theirs is Hometown Studios, I think. But anyway, they didn't require us to do that. And again, I think one of the key things there I'll point out on these slides is that there are no other extended stays in this market. There's no other hotels doing this model. And most of the hotels that we compete against have not been recently renovated. They're old and worn out. And I just have a list of some of the things that we've done, which was pretty extensive. I guess I shouldn't say we did it. We bought it completely done.
That makes life a little bit easier.
Yeah, here's some other pictures. Obviously, you can see when we bought it, nobody was staying there, right? I mean, when we bought it, it hadn't reopened yet. But I'll show you in just a couple minutes here how we've progressed since we reopened. But as you can see, I mean, it is, it needs nothing, right? I mean, everything was done right in this renovation. That's what we liked about the renovation. So again, we've got a completely remodeled property. We're in a really nice, stable, slowly growing market in Georgia. Thomasville is actually about 30 miles north of Tallahassee, Florida. So, and one of the key things about Thomasville, the market, is that it actually is the healthcare hub of that region. So, and when I go through the full presentation, basically I show people we're getting the right property. It's a great market. We're buying it at the right price, and our 50/50 model is the right model.
I love it. If anybody is trying to get more information about this or the other things that you're working on, what's the best way to get a hold of you?
Basically, I would say the best way to get a hold of me is by email, david@firstfloorequity.com, and that's all spelled out, FIRSTFLOOREQUITY.
And we will absolutely include that in the notes for anybody that is watching this as well. So I hope y'all learned a whole lot from David Peters, and really I see this as being the opportunities of the future as the markets shift, as the multifamily affordability, both to purchase as well to rent from it, is just getting sky high. Well, this guy has found a niche, how to buy at great cap rates to convert to those multifamily cap rates. Really doing a service to America in increasing the apartment availability. And you know what? That's what is going to really save and change the affordability for the masses that are just trying to make it by day. So, David, I truly appreciate you being here today and really sharing about your investments, your background, and your trainings, and the way that people can participate and learn and grow with you. So I really want to thank you so much.
Well, thanks, Nate, for bringing me on and giving me the opportunity to speak to your audience. And obviously, we've had a relationship for quite a while now, and I look forward to, working with you and your firm long into the future.
Couldn't agree more. So thank you, everybody, for listening, for watching, and this is why.